This episode is brought to you by Marqeta. Payment programs that scale and customer experiences that inspire. Don't sacrifice one for the other. Choose a payments provider who can deliver on both. Choose Marqeta. Learn more at marqeta.com/FTT. Hello, and welcome to a special live edition of the Fintech Recap Podcast. As longtime listeners of this podcast will know, Jason Mikula and I try whenever we can to record a live podcast from the show floor at Money20, and we were able to do that this year. So the podcast you're about to hear is a shorter than normal version of Fintech Recap. Jason and I talk a little bit about what we saw and heard at Money20. We talk about open banking now that the comment period on the ANPR has closed and the CFPB now has 14,000 comments to read. We talk about Erebor, which just got conditional approval from the OCC for its national bank charter. And then, as we always do, we ended with a couple quick but very dramatic and fun Can't Let It Go rants. I hope you enjoy this short and sweet Money 2020 live edition of Fintech Recap with Jason Mikula. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. All right, well, Jason Mikula sitting across the table from me here at Money 2020, a tradition like no other. Jason, it's great to see you in person.
It's great to see you. I'm surviving. I got this and then a sprint to the Uber line to the airport.
That's right. Yes. Well, we appreciate you fitting us in before you have to make your epic journey back home. How's how the last couple days been in Las Vegas?
Excellent as always.
Yeah.
I am dehydrated. I need to moisturize. I need to consume many bottles of water, but otherwise good. Always fun to catch up with people face to face. I actually legitimately like walking the show floor to see like who's exhibiting this year that wasn't here last year.
Totally.
Unsurprisingly, lots of AI, lots of stablecoins.
Yeah.
How has the show been for you?
Similar. It's been very, very busy as always. I guess the benefit of everyone being together in one place is that you just see everybody. And I will say it is remarkable at Money 2020 how you actually run into all the people, right? You're not like, there's 11,000. We might not see each other. Like somehow you see that person. So
if you just park in front of the Starbucks, you will see everybody.
Right. So. Everyone eventually finds you. So I managed to find most people, which has been great. And very, very busy event. Will second your point about stablecoins and AI being the dominant themes at the event. I was walking around the show floor and AI is like, I think you're getting fined if you're a marketing person and you're designing the graphics and banners for your booth and it doesn't say AI, like we will dock your take-home pay. So lots of marketers doing what they need to do to stand out by fitting in. I don't know. I mean, Jason, what's been your conversations on AI stablecoin topics? Like how is it filtering from the messaging to actually the pitches you're hearing or the stories you're hearing?
I mean, on the AI side, I think the biggest pitch is, specifically the agentic piece of it, which does feel like it has a slightly different flavor maybe than some of the conversations in that sort of AI lane, a year or 2 years ago.
Yeah.
And the primary sort of vertical I hear people, there's probably information availability bias given given the topics I focus on, but a lot of the compliance use cases, right? Yeah. So, automating things and using agents for things like, case management, SAR filing, and whatnot.
Yeah.
Then on the stablecoin side, again, probably not anything surprising to you because I know I feel like we talked to 98% of the same people.
Yeah.
But, cross-border, so specifically remittances, use case for store of value in economies that are either, high inflation.
Yeah.
Those seem to be the recurring themes.
Yeah. No, that sounds right to me. I will just add to that on the AI one, even though I was just sort of giving all the vendors a hard time about their booths, I will say the conversations I've had with people about AI this year seem more tangible maybe than previous years.
I would agree with that. I would second that.
Yeah, there's like an element of, I'm almost trying to think of the right way to describe it, a recognition of what AI use cases make sense, which ones don't, how to sort of draw more clear lines around it. I mean, I remember last year it was much more just like, we're doing AI things. And you're like, well,
what does that mean?
What does that mean? And where are you putting it? And like, we almost didn't have the language to describe it. And I feel like we have better language and better specificity.
Yeah.
So I feel, I guess, mildly optimistic on that front. I, of course, also got to see our friends at the Federal Reserve who have a booth still pushing faster payments, which in some senses, I guess, feels quaint now that we're in this era of stablecoins. But, everyone is still out there doing their pitches. Jason, we're, as always, in this podcast, going to recap things that have been happening. I genuinely really don't want to do this, but we should probably briefly acknowledge news that broke last week. We're not even going to stop at Bass Island. We're going to fly by at hyperspeed.
Okay, I will not take too much of our very limited time on this.
Yes.
But let's just say I got a text message, technically a signal message, on whatever it was, like last Thursday, that FBI had raided a certain bank that, I'd love to talk about.
Yeah.
Actually, you were on the text chain, so you got my text.
I did.
This is a family show, so it's finally happening, maybe.
Yeah.
But lo and behold, it was the Evolve CEO being arrested for allegations of child sexual abuse material, nothing related to the bank. I actually spoke with FBI comms person who said there was an arrest warrant and a search warrant that were executed at Evolve's headquarters.
Yeah.
As we like to joke, bankers don't usually get arrested, and usually not by FBI agents in camo and bulletproof vests.
Yeah.
So definitely a interesting, unfortunate side tangent of that never-ending story. And unless you have something you want to add, I think we can probably leave it there.
I have nothing to add except to say that random terrible things seem to happen in the vicinity of Evolve, just like as some law of the universe. At some point, I presume that will go away. Obviously, with you that it's a terrible story, glad law enforcement is involved, and I am happy to leave it right there.
Yes.
Let us talk instead about one of my hobby horses, which does not involve quite as much dark material, although it is still very dramatic, which is open banking.
So there were 14,000 comment letters. How many of them did you read?
I'll be honest, I have not read very many of them at all yet.
I think Evan from Bloomberg Law, I think he wrote a story that implied that he had read a substantial plurality of them.
Yes.
There were form letters, though, so it was a pain to try to isolate the real ones from the carbon copy form letter ones.
That's the thing. And this happened last time. We were going through the comment period for the final rule that's now in place. There were 12,000 or whatever, and 99% of them are the same form letter over and over again. The federal government needs to figure out a way to segregate those from the other ones, because it makes it really hard to parse. But of the 13,979 comment letters that were submitted, there was actually a lot of interesting sort of meat and arguments in all of those comment letters. Can I summarize a few real quickly for you?
Please do, because like I said, I think I read 4 of them.
Yeah.
The big 4.
The big 4, right. Like the names you were looking for. Yes. I read those, and then I poked around a couple others. I also obviously read Evan's piece at Bloomberg. A couple of things that jumped out. One is obviously that cost came up, which I know you know. Not surprisingly, banks were generally in favor of being able to charge prices. Aggregators and fintech companies were, in fact, against that. Shocking. We knew that Plaid was going to submit a comment letter where they opposed the pricing that they themselves already agreed to. That did happen. We don't live in an era where irony exists anymore anyway, so that's fine.
Well, I thought it was particularly interesting because that Plaid's comment letter argued that in the text of the statute itself, so in section 1033 of Dodd-Frank, that prohibits fees because it's something along the lines of shall make available.
Yes.
Which, I don't know. I'm not a lawyer. I don't really want to be a lawyer, but it feels like it might be stretching the definition of some of those words. But.
Oh, yeah. Well, and that's kind of the context for all these comments really, is that they're going back to this very short statute that exists in this massive piece of legislation that was written, in 2010. And so it doesn't really, I don't believe, make sense to hang a lot of sophisticated arguments on such a short, vague statute. But everyone tried. regardless. As we knew Plaid was going to make this argument, they actually wrung out of Chase a concession that they were allowed to argue for whatever they wanted on the policy side.
Was that a parting gift to our favorite policy person, John Pitts, before he departed Plaid?
It must have been. It must have been. I mean, I know his fingerprints are all over the comment letter that Plaid submitted, so kind of his going away present. So I thought that was interesting. I thought that, if you read smaller bank comment letters, they also talk about pricing, but I think they frame it in much more of a kind of plain vanilla cost recovery language. Chase talks about it in a cost recovery language, but I think there's all kinds of other objectives they have woven into that pricing. Smaller banks are much more nakedly just like, look, we can't afford to stand up these APIs. We're not getting the support we need from our core providers, that kind of stuff. The interesting thing to me, and I'd like your take on this, is I don't think small banks are going to be able to let the market forces help them in this regard, right? Like Chase has a lot of leverage with Plaid. PNC has some leverage with Plaid. Bank of America has leverage with Plaid. Small little community bank in the middle of the country has no leverage with Plaid or any other data aggregators. And so I think one of the things to distinguish between big bank commentary on this proposed rule or this revised rule and small bank or community bank and credit union commentary is the small banks and credit unions, I think, are actually asking more for protection from the CFPB, whereas Chase and the big banks, I think, are asking for just take the gloves off and let the market do what it's going to do.
Yeah.
And, to be honest, I don't have a good sense of how that, from a statutory rulemaking perspective, is going to work itself out because, if you're the CFPB, do you set a safe harbor price that everyone has to pay, that some people can pay? Do you allow the market to just sort of negotiate and say fees are allowed, but we're not going to say which fees are allowed or who gets to set them? So I don't know if you have any insight into that.
Well, and I mean, speaking of safe harbor and then, smaller banks that may just struggle to have the resources to implement what a rule may require. Correct me if I'm wrong, but the existing rule, which reminder, remains in effect.
Yes.
Isn't the asset threshold 850 million? So if you're a community bank below that, you don't even have to comply.
That is correct.
So you could imagine a world where maybe there's a higher asset threshold, and we're saying, I mean, everyone's obsessed with the number 10 billion. Why don't we just use that? Maybe if you're a community bank below 10 billion, you don't have to comply at all.
Yep.
Maybe there's some sort of different options around pricing or cost recovery based on institution size. You'll recall that in the ANPR, there were questions around fixed costs and variable costs as a function of the size of the institution.
Yeah.
I mean, I try not to, predict the future because I'm frequently wrong. But I kind of feel like the way that this is going to shake out is the final rule is silent and they let the market figure it out.
Yeah.
And where that leads, I guess, inevitably to more litigation.
Yeah, I mean, the one thing we know for sure is that someone's getting sued on the other side of this, right? So like a lawsuit is going to happen, whether it's BPI just firing up the same lawsuit as before, or it's the fintech companies and fintech trade associations and data aggregators. Someone's going to sue because no one is going to get what they want, and now we can sue for eternity, forever, and lawyers will benefit from that. So we know that's going to happen. We also know that banks and data providers, kind of as the category, still are expressing concerns around fraud. They're expressing concerns around liability. They're expressing concerns around third-party risk management. One of the comment letters asked for some type of rolling certification process to certify third parties that want access to the data, much in the same way that you need to get SOC 2 Type 2 certified or PCI certified. You should get certified to be able to handle open banking data. I doubt that the CFPB is going to do a ton there because they don't really do certifications themselves. I mean, the CFPB is 4 guys and a ham sandwich now. So it's not like there's a lot of people working there who could do this work anyway. I mean, they're going to be challenged on just writing the rule to say nothing of anything else. But I do think private industry might step in there. And you could imagine a certification type entity that's kind of
whether it's FDX, FData, or some new entity that that is
Correct. Right. The FDX handles the technical standards, but then FDY, I'm just making up acronyms, they handle certification and third-party risk management. So I could see more private industry stuff stepping in, assuming that banks and fintech companies can all get on the same page about this, which is, of course, going to be the big challenge because a lot of trust in this ecosystem has sort of been fractured. And then the other one, Jason, I wanted to mention to you real quick is big tech was pretty quiet in the comment letters, from what I could tell.
I didn't come across, I did not search all 13,000+, but I don't recall seeing much commentary both in those official comment letters or kind of in like press, media, what the sort of big tech attitude here is.
There really wasn't much. The only one, and Evan wrote about this in his piece as well, is Apple. And Apple did submit a comment letter.
I did not read that one. What did it say?
It was interesting. One of the things that Apple was kind of pushing for is this idea that big tech should sort of not be swept up into this rule if the technology company in question is not providing the actual financial account. So you can kind of you can put this in the frame of the Chopra era CFPB, in which any small little mouse hole where you could try to get to investigating Apple, Google, Meta, name your very large technology company, Amazon, that they were going to take that, right? And so you could see an argument with a sort of expansive view on 1033, which is 1033 applies to all of these covered accounts and any institution that provides those covered accounts, which could broadly be construed to be Apple with Apple Pay or Apple with the Apple credit card. Apple was making the argument, and I don't even think they really had to make this argument because I don't get the sense the CFPB currently wants to go in this direction, but they were making the argument that, look, if we offer a credit card through Goldman Sachs, at least temporarily, that credit card and the sort of attendant responsibilities under 1033 as a Reg Z product, those fall under Goldman Sachs purview. That has nothing to do with Apple. And that doesn't give consumers a right to share their sort of broader, let's call it Apple ecosystem data. So I think that's what they're trying to sort of guard against is like keep the scope really tightly focused on these covered accounts. I think that's really interesting because in a sense, I'm actually kind of surprised Apple even submitted a comment. Because I think in some ways, like it's one of those don't ask the question unless you want, like you're sure you're going to like the answer. And I think them bringing this up does pose sort of a broader question, which has come up in some of my conversations this week, which is, shouldn't we be having a conversation about big tech sharing their data or making their data portable, right? And I think particularly in the age of AI, this really matters, right? Like a question I would love to pose to the right person at OpenAI is, hey, in the future, will people be able to take their OpenAI chat history and make it portable to other AI chatbots?
That is interesting and almost inviting questions you imagine Apple and its other big tech companies wouldn't want to be asked around, not just quote unquote open banking, open finance, but like true consumer ownership of data that exists in these platforms. I mean, as you were sort of talking through that, it's like if I wanted to stop using Gmail, which I've apparently used for like 15 years, as far as I'm aware, there is no easy mechanism to port that entire history of the tens of thousands of emails I've sent and received to some new platform I might want to use. And so you create this like walled garden lock-in effect. I mean, I'm not going to hold my breath that any current regulator or legislator is going to be tackling that question if, it's whatever, 15 years on from Dodd-Frank and we still don't actually have a real agreed upon open banking rule. So.
No, I think that's spot on. Jason, can I ask you to give us the real quick update? Because I know you wrote about this in your newsletter on Erebor, which is a bank that's named after a Lord of the Rings thing that just continues to make me mad that they steal names from that universe. What is Erebor and what happened? When it comes to your payments provider, you can't afford to compromise. Marqeta's modern payment solutions flex with your business without the trade-offs. Stable and agile, secure and innovative, scalable and configurable. If they say you can't have it all, don't believe them. Your business demands more. Choose a payments provider that delivers more. Choose Marqeta. Visit marqeta.com/FTT to learn more.
Yeah. So first of all, I have never read a Lord of the Rings book, nor have I seen. Yeah, we can talk about that some other time.
We will talk about that some other time.
No, I was not a Lord of the Rings fan.
Boo.
But yes. So the name most associated with this is Palmer Luckey.
Yeah.
which, if you don't know who that is, Google it, because he has a very interesting aesthetic. It involves Hawaiian shirts and a pretty severe mullet.
Yeah.
Not passing any judgment. But Erebor submitted a application, and this is for a full service
national bank
charter, OCC. So not a trust bank charter, which a lot of these other crypto stablecoin firms have been pursuing.
Yeah.
Lucky has connections with who's who of Silicon Valley investors, most notably probably Peter Thiel.
Yep.
And the application received a conditional approval in, it was like 123 or 127 days. I can't remember which.
Which was very fast.
Yeah. I actually looked at, and this was data that Claros had put together, that Michelle, one of the co-founders of Claros, wrote a letter at the beginning of the Trump administration, basically advocating for some reforms around bank chartering process.
Yeah.
And, in that letter, it had a breakdown of some of the timelines of, how long it would take to adjudicate like a charter application decision.
Yeah.
And there were some that were, in that sort of 6 to 9 month time frame, but it's definitely at the shorter end of the spectrum. And then specifically the bank, and I think you posted something on this, which I had to chuckle at, in an interview that I think it was Lucky who had done, describing it as like a bank for him and his friends.
Yeah, yeah.
So basically, the language in these charter applications tends to be pretty banal. Like it's hard to parse too much out of it, apart from, in this case, talking about catering to like high net worth individuals, technology companies, and some ancillary like crypto related things.
Do you want the quote from
yes, please.
the thing? I have it.
You actually have your notes. So
this is Palmer Lucky's quote. It's one of the few finance companies that's started by somebody who wants it to be in service of all the other true interests they have, rather than the culmination of their own personal interest. I have no idea how to parse that quote, Jason.
I don't know what that means.
I don't know what that means.
I think there's also a sentiment that this is kind of like, we lost SVB. I mean, SVB still exists.
Yeah. They have a booth back there that says we're still here.
But sort of the, Silicon Valley bank that catered to VCs, catered to founders, including with perks like, cheap mortgages,
access to ski chalets. Yeah.
I do not get a ski chalet with.
You don't?
I do not.
Oh.
I think there's a couple of interesting angles to this story, which sadly we do not have enough time to unpack.
I know.
The piece that I am most interested in, and this extends also to some of these other trust charter apps, is whether or not this is actually pay to play. It certainly starts to look, feel, and smell like pay to play.
Yeah.
I'm not naive enough to think that, money has not always been a force in politics, including in sort of like the banking and regulatory world.
Sure.
Which certainly it is. But when you see the insane amount of money that the crypto industry broadly has plowed into politics, into electoral politics, like they're calling in those chits. Chips? I don't know which one.
Chits, yeah.
Chits. And we've seen it with Genius.
Yep.
We're seeing it now with so-called market structure legislation. I really need to like unfollow or block Brian Armstrong because
you can't.
Like, his manic level of tweeting is like really grating.
Yeah.
But I think it has a very pernicious effect in the trust that people have in institutions, and also where risk is going to build in the ecosystem.
Well, the OCC, they were founded during the Civil War, right? So like it's a very long-standing agency that's supposed to have this sort of credibility that extends beyond any one particular time. And to your point, there was reporting that part of Erebor's like pitch to investors was the close ties that they had to the OCC, which would facilitate a fast turnaround. So it's hard to say, it's hard to parse from the outside. Was this fast turnaround just reform at the OCC and everybody's going to get this treatment? Was it a coincidence that this was the first new de novo national trust or national bank charter that was approved conditionally by the OCC? Or is this just random? Like, those are the kind of questions you have to ask and not know the answer to in this era. Speaking of this era, Jason, we have 2 minutes left. You get the chance to rant about anything you want in our Can't Let It Go segment. What do you have for me?
I feel like, unfortunately, we're both talking about crypto too much these days, but the CZ pardon. I mean, come on. Talk about pay to play. Like that, when you hire a friend of, I forget if it was Don Jr. or Eric to lobby for your pardon, when you have $2 billion that go into World Liberty Financial's USD1 stable token related to Binance, which, by the way, I Googled this while we were waiting to start recording.
Yeah.
That's 2/3 of the entire circulating supply of USD1.
Crazy. But it's a coincidence, Jason.
Yes, sorry. Yeah,
it's a coincidence.
Arm's length negotiation and transaction.
Yeah.
Again, it's not that everything works perfectly in the United States, 5 years ago or 10 years ago or today.
Sure.
But the impact of money, not only on politics, but now increasingly on the regulatory sphere, is corrosive. And like the problems that are brewing there, will come home to roost eventually. Somebody yesterday at one of the happy hours told me real 2021 vibes, like really frothy, everything's great.
Sure.
But do you remember what happened in 2022 and 2023?
Yeah. We didn't have a ton of fun then.
Yeah, those weren't fun.
No, those were sort of sadder Money 2020.
What can you not let go of today?
I'll do it super fast. This happened today, as if like fate and Providence was just providing me with a rant to end the podcast with. But Trump Media and Technology Group, which owns Truth Social, Truth Plus, which is a streaming platform I didn't even know about, and the fintech brand Truth.fi, which I don't know what that does, announced that it will make prediction markets available on Truth Social through an exclusive arrangement with Crypto.com's new derivative trading platform affiliate, regulated or not by the Commodities Futures Trading Commission. And Jason, I'm just going to read this sentence and you just tell me like if you want to just quit covering fintech altogether. You ready?
Ready.
Truth Social and Truth Plus users who have Truth Gems, which are earned for interacting on the platforms, will be able to convert their gems into Chronos, digital currency, and apply them to the purchase of Truth Predict contracts.
I'm just gonna quit and go work on a farm or something. But we're at time, so I guess we're gonna have to leave it here.
Yes.
But I look forward to seeing you out in Montana in like a month.
Yes. We'll be hosting a Builder Summit. Jason will be there. And Jason, until then, thank you, sir. This was fun.
Thank you.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.